Hey, this is Andrew Berman from National Mortgage Professional Magazine. Thank you for joining us for another NMP webinar. We're going to be getting started in a little bit. Just want to give a little bit of time for everyone to get in. So listen, and if we do have a number of questions that have already been submitted. So if you have any other questions, still have time. You got that little box on the right-hand side of your screen. Get your questions in. The only bad questions are the ones that you don't ask. That's something my grandfather always told me. We're gonna, listen, he's got a lot of great lines like that. Things that I always carry myself. So with us, that other guy that you're hearing is Tom Hutchins, who Executive Vice President of Production for Angel Oak Mortgage Solutions. Tom, say hi to everyone.
Hello, everybody. Thanks for taking some time out of your day to join us today. Excited about what we're going to be talking about.
Listen, I mean, if they're, I know the majority of our readers are already doing non-QM business, and they're loving it. There's a lot of great things actually that they're finding with it, besides actually creating new opportunities. And we'll go into a lot of this. But I mean, this is great actually for people. Actually, if you're already expert level on this and you're already doing some non-QM business, you're going to learn some things from this webinar to just kind of enhance your practice. And if you're not doing it, I mean, I'm just telling you, just get involved. I mean, obviously, I've got a special, love towards. But listen, if you have, there are tons of lenders out there that are offering services. Angel Oak provides a lot of resources to kind of get you started, and Tom is going to go into those a little bit. Tom, we'll give another minute or so because I'm just seeing people piling into the room right now. Yeah. So I just want to just kind of let everything flow in here.
Yeah, I'd say we probably get going in a couple minutes. So anybody who needs to get a drink of water or something now would be the good time to do that.
Perfect. Listen, so let's take Tom's cue. Go great. Go get some water. All right, I'm good. Get your water. Oh man, I'm out of coffee. That's not good. But
maybe some people on the West Coast, they probably still want some coffee.
Hey, someone get me some coffee. There's no one listening. There's no one even listening. No, there's some coworkers that are probably going to throw a coffee mug at me right now. So, if all of a sudden there's an incoming coffee mug, we know what that is. But yeah, we'll get started here in about 30 seconds.
Yep. So get your coffee. A lot of people calling in right now, so log it in. So
this is a good time to do. Everyone, take your phone out, put it on silence. Shut it off. I'm going to put my phone in airplane mode.
Smart.
If anyone needs to get a hold of me, they're going to have to wait for 50, 60 minutes till we get started here. All right.
Without glad to see somebody let us know that she has a full cup of coffee sitting next to her. Thank you for that, Cynthia.
Great.
Awesome.
All right. And without further ado, present to you.
Awesome.
QM should be part of your origination mix. With us, again, we have Tom Hutchins, who's Executive Vice President of Production over at Angel Oak Mortgage Solutions. There's the leader in the space when it comes to non-QM. I've heard people refer to Angel Oak as like the Kleenex or the Xerox of a non-QM business. They've paved the roads for a lot of other lenders that have started to offer it. But we've got some great things here. We got some great questions, and if you have questions, please start submitting them. You'll see the box on the right-hand side. You could start to put in your questions. We do have some questions that came in from before. So, Tom, take it away.
Yeah. Okay. Hey, a couple housekeeping items too. This webinar is being recorded, so you don't feel like you have to take a lot of notes and do all that. We will send it to everyone who is registered. So if you're attending, you have registered, and we will email that out with some other things. So just to note, assuming we have no problems with GoToWebinar, which 99 times out of 100 it works just fine. So we'll go with that. All right. So thanks for the intro, Andrew. I think we'll kind of just jump right into it. We've got an hour reserved here. If we can get done with this in less time, we certainly will, but I will commit to not going over an hour. So let's just kind of go over really the agenda. First, we're just going to talk about Angel Oak. I'd like everybody to, have a little bit of understanding about who we are. Really, what is alternative lending, non-QM? What does it mean? How can non-QM really help you close more loans? Where to find these borrowers, and then really talk kind of at the end about differentiating yourself in the market. I think that's a really big piece of the non-QM. Sound good, Andrew?
Sounds awesome. Yep.
Okay.
I love it.
All right. Just making sure you're still there. All right. So first of all, just Angel Oak. Let me just tell you a little bit about us. We've been in business for a little over 5 years now, doing this non-agency, non-QM exclusively. And really, our initial goal was just to get private capital back into the mortgage market. You hear a lot about, out of Washington talking about wanting to scale down the agency lenders and all that. And really the only way that's ever going to happen is that if private capital comes back. And, post-crisis, private capital just got out of the mortgage space. So the only thing we were left with was agency and government loans. And so really there were two types of loans post-crisis: agency, government, and then hard money. And so we felt like there was a really big gap there between the two. And that's what we wanted to fill. We wanted to fill that gap between agency and hard money. And that's really that's what we set out to do from the start. A lot of things make that happen, but good quality originations has really been at the forefront of bringing private capital back, because everybody remembers when good originations were not occurring. So that's been kind of the focus of ours, and we believe that our products and programs and the way that we do business has really succeeded at that. So that's the gap that we want to fill. Just a little bit about us. We're vertically integrated, and really what that means is that we take the loans from origination all the way through securitizations, and it's all under the Angel Oak umbrella. We have some affiliated companies, Angel Oak Capital. They take our loans and they securitize them, and then they sell the bonds off to investors. They've done 8 of those to date, starting in 2015. They're actually rated securities now, which when we started this, the rating agency says, no way, we really can't rate non-QM, but we actually have been able to achieve that. And when a transaction is rated, what that means is that different investors can get in, the big banks, insurance companies, and so really that means the flow of the private capital is all set up, and that's really what we've worked really hard to do. So again, I already mentioned we've been doing this since 2013. We only do non-agency and non-QM. So we don't do Fannie Mae loans. We don't do any government loans. This is all we do. So I think that's really important for you to know. We are seeing a lot of lenders that are now offering non-QM, but that's all we ever offered. So we absolutely believe we have kind of an expertise in this space. And that's important for everybody to know. Wholesale and correspondent. So regardless of how you want to do business in the non-QM space, we have a channel that's right for you. If it's something that you just want to broker out the loans to us, we're perfectly fine with that. That's how we began the business. But correspondent, we've been offering for a couple of years now, and we're seeing a lot of growth in that channel as well. So both channels work. We are now licensed in 42 states. We have a large number of approved brokers, over 2,500. We've already closed over 8,000 loans since we've been doing this. So again, it kind of speaks to the expertise. We've done that many loans, and it's the only kind of loan we do. So, we know what we're doing. Customer service. We have lots of stories, but when we started this effort, we really have always said that, the customer service and the customer experience has to be at the forefront. We know some things about these transactions, especially when we started. A lot of the non-QM loans were fallout loans, and one thing that we know that does not change in a purchase transaction certainly is that closing date. So the contract has a closing date, and even if the loan has kind of gone around in circles for a few weeks, the loan officer still has to get it closed by that closing date. So we put a real emphasis on speed and communication and things like that. So, and in fact, here they are. We access to underwriters. Really believe that's a differentiator. We want the originators to have dialogue directly with the underwriters. We don't shield them. They're not behind a black curtain just making decisions. They're actually working with you as a customer of ours to structure loans and to get those done. Common sense approach. If you've been in the business for a while, you remember pre-crisis, a lot of decisions were common sense, and we've brought that back, and that's really what our loans represent, our common sense underwriting decisions. We have an easy website that we're going to spend some time on today, and I'll show you around that. We have nationwide coverage, so we have salespeople in virtually every market. If we don't have a person locally in the market, we have someone kind of inside that covers the market. So all over the country, and I'll show you a map actually in a little bit of exactly where we are, but you can find the person that's close to you and is happy to come by and meet with you individually. And then proper expectations. We are big believers that the customer service experience is based on setting the proper expectations and then living up to those expectations, and in a lot of cases exceeding those. We are the largest non-bank originator of non-QM loans. It's been a really record-setting year for us, and we just finished October, and October 2018 was our biggest month yet. So, we just continue to break records month after month, and a lot of it is just what we're doing today. It's the education of originators about the non-QM loans that we do.
It's kind of getting boring. I mean, you guys keep breaking records. It's like every time. It's just like old news. It's phenomenal. So listen, if you don't mind, Tom, I want to launch a poll question. So by the way, during this, we have a couple of polls that we're going to be asking the audience. But please go right ahead, submit. Actually, I see votes are rolling in fast. Have you closed a non-QM loan? Yes or no? And it looks like 33% yes. It's most of them not. We're looking actually at only 65% no.
Yeah.
We're going to leave the poll open for another 10 seconds.
Yep. Well, and that's kind of to be expected. And Andrew, I'll just address even what you were talking about as the numbers and us continuing to break records. A lot of that is because of this, the poll question that you're showing right now is a lot of people still have not participated in the non-QM space. What we've really seen though is everyone continues to learn more about it. And so that's why we're even doing this webinar. So this 65% of the people on the call who have not closed a non-QM loan can learn more. And then the 35% that have, hopefully they can learn more about, hopefully it's been with Angel Oak, but if it hasn't been with Angel Oak, there's still a lot to learn. And we want everyone to learn about non-QM and about Angel Oak. So that's really what's going on. So
I'm going to close the poll out. Last 5 seconds. 5, 4, 3, 2, 1. And there we go. I'll share the results so we can see what we're looking at here. By the way, great job. We had 70% of the people actually that were on this webinar right now voted. So great job participating. But so we've got 64% have not closed a non-QM loan in the last 12 months.
Okay, well that's great to know. So we'll go with 2/3, and again, hopefully by the time we wrap this up, everyone who has not is going to know enough and be ready to start participating in the non-QM space. Which I'm guessing just by the fact you're spending this time with us is that there's a desire there to learn more and to participate in this market.
Fantastic. All right. Great. And by the way, I see we're starting to get some questions come in. If you just came into this, please, we're going to look for your questions. We'll save them till the end. But if you can just kind of use that little box on the right-hand side and start submitting your questions, and we will make sure we get to as many we can.
And Andrew, if you see some questions that you want to just kind of, are pertaining to what I'm talking about or whatever, if you think it's a question we should address now, go ahead. We don't have to save everything to the end. I will say, if we don't get to your question, we will have your question, and we'll get an answer for you following this webinar. So please submit it, and we'll go from there. Okay, so another piece about non-QM is, we're not going to do a poll question, but I always like asking, who was in the business pre-crisis, because I think it's really important, if you were in the business pre-crisis, and a lot of us were, is to really understand the differences between pre-crisis and today's loans. And really, everybody can remember back in the day, 2005, 2006, the average FICO in the non-QM, which was then really called the subprime Alt-A world, the average FICO was around 580. So if you had a borrower with a 610, 620 score, that was a slam dunk loan. In fact, 580s, near the end, before the crisis, 580 loans were very common. In fact, that was the average. But today, and this is really since 2013, our average FICO of these non-QM borrowers has been north of 680. So that's just a really interesting dynamic to me, that the credit is actually, we have people that have had maybe a credit event, but they've worked real hard to get their credit back. But because of agency and government guidelines, they can't get a loan. So we see borrowers with credit events not too long ago that have worked really hard to repair their credit, built their credit up, but they're never going to get an agency or a jumbo loan because of the seasoning required. Down payment, we actually need to update the screen because we just came out with a new program. But back, pre-crisis, every loan was a no money down. It was either 100% one loan, or everybody remembers those 80/20s. But now there are down payments required. This says, a minimum of 10. We actually rolled out a product last week that's a 95% loan with no mortgage insurance. So, we're getting, borrowers are coming to the table with their own funds, and we believe that's a big part of the performance of the loan. Skin in the game is the phrase that we use often. But as we've continued to offer, we started out with just an 80, then we had 85, 90s, now 95s, but our overall average loan to value is still under 80. So that means that people have equity and they're bringing money to the table, to the closing table, and it makes a huge difference. 2006, proof of income, it just wasn't required. Andrew, remember ever hearing the word Nina or Ninja or CISA or SIVA or
what were we thinking? Well, as an industry, what were we thinking?
All these different variations of no income. Now, because, in fact, the last point, oversight and regulation, because of the Dodd-Frank Act and the ability to repay, every non-QM loan for a primary second home has to have a documented ability to repay. So we'll talk more about that. We have some alternatives to agency documentation, but it still has to be documented. And we think that's a great law, and it works for us, and that's the space that we participate in. So make sense before and after?
Yeah.
Bottom line.
We look at it. It's like, what were we thinking as an industry in 2006? We look at so no money, not great credit, kind of shoddy proof of income. I mean, it's a miracle actually it didn't get any worse. But yeah,
layered risk is what that's called, and got a little out of hand for sure. So another thing that I think is important for people wanting to get into the non-QM space is just to understand, what kind of opportunity is there in this space. And so here's a graph. You'll notice the blue is agency production and the green is non-agency. So call it non-QM, non-prime, alternative. It's just not agency loans. But you can see back in the 2001 to 2003 range, that's really, the market was somewhat normalized during that period. So you had over $1 trillion in agency and let's say $250 billion in the non-agency. That was a reasonable level. That's when guidelines in 01, 02, even early parts of 03, the guidelines really, they made sense, kind of like what we just talked about, what it looks like today. You look at 02, similar, $1.5 trillion almost, and 400 in non-agency, and again in 03. So that's really the time period that we look at as far as what is the opportunity in non-QM. But then you look fast forward, look at 14 through last year. All you see is blue, right? I mean, there is no green. And in fact, the majority of this non-agency down here, it's just simply prime jumbo. So it's not even, the non-QM production has not really been large enough to date to even make a big mark on this graph. But so we think 250, 300 billion a year, comparing it to like 01, 02, we believe that that's absolutely what's going to happen, and it's a reasonable, sustainable level, and with guidelines that make sense. So we're just getting started. That's really the message. Even though we've been doing this for 5 years, it's not too late for those 2/3 of the people that are on this call that have not done a non-QM loan. We're still just getting started. Maybe the industry is at 20 billion altogether. It's a lot of non-bank privately held firms, so it's hard to get an exact number, but we know it's very small and with a huge upside for growth.
You're not going to give your hockey stick analogy? I love the hockey stick analogy.
You like that? Well, so that I'll go ahead and do that now for you. But we've said since 2013, and Andrew brings this up because we've known each other for a long time, and he knows I always talk about the hockey stick, and all that really means is we believe the business is going to do this and then just take off. Yeah. And really, 2018, we're starting to see the takeoff. The good news, though, is we're really still at the base of the hockey stick. We haven't gotten to the top where you hold the stick. So tons of opportunity, but it really is taking off. So kudos to all of you that are on the webinar today to learn more about non-QM, because it is growing and growing rapidly. Fantastic. Thanks for that reminder.
Yeah, no problem. I just love it. It's like when you said that, I'm like, oh, I get it. We're at the base of it. So listen, we still have there are a lot of general product questions. There are four lenders that wanted to know if their company's already signed up, but we'll answer those privately. But I want to do a poll. So since we're talking about actually, the potential for it, I want to know from the audience, what is your perception of the non-QM loans? So I just want to get actually a temperature for the room. What is your perception of the non-QM loans? Are they very positive, neutral, negative, very negative?
Okay.
Yeah, only 2% negative nillies here.
Yeah,
4%.
See, you had to say that, didn't you, Andrew?
The cynics are showing their votes here.
Yeah. All right.
We're gonna give another 5 seconds here.
Yep. Okay.
5, 4, 3, 2, 1. Okay, we're closing now, and I will share the results here.
Yep.
All right. So there we go. So we have the leader in this is positive, not very positive. From Tom, you're out there working with a lot of originators. Is this kind of in line with what you're seeing out there on the street?
Well, I mean, this to me says that 94% is neutral to positive, and if we have a majority of the people on this call have never done non-QM, it would be hard to your perception isn't really based on experience on the loans or perhaps even knowing what the products look like. So yeah, I'd say that's awesome. I mean, the 75% or so that are positive to very positive have likely done some business in this space or obviously heard good things about it. So yeah, that makes sense.
Yeah.
So this is something that we'll just keep going, Andrew. But to me, this is a screen that really kind of addresses the perception that you just mentioned. So I talked earlier about securitized loans and rated transactions. Well, once a security has been rated, the actual performance of the loans behind that make up these bonds becomes public data. So Fitch came out earlier this year, and they, since 2015, looked at 11,000 non-QM loans that had been securitized, $4.3 billion in production, and there have been a total of 8 that have gone into foreclosure. So
did your marketing department make a mistake there? Because it says 8, not 800, not 80, 8.
8, and that's, that kind of speaks to what I mentioned earlier also, performance. We had to and continue every single day. We have to find those good borrowers that are qualified, that have the ability to repay, and the numbers kind of speak for themselves. I think we're doing a good job of that. So 8 foreclosures, I think Fannie Mae, FHA, I think everybody would love these kind of performance numbers. And really that's kind of what's fueling the continued growth, because investors see this as well. So they see how, how little risk there is to participate as an investor in the non-QM space. So, I would just say, so you as an originator, you've got to get in. I mean, these are good loans. These are better loans than those FHA loans that you're doing and you've been doing for years. So
those that 6% that said negative or very negative are right now eating their hat when they see this set.
Well, that's why we're here, Andrew. This is education.
Yeah.
Not people still might relate it to the kind of the old subprime and really seeing that this is different and understand that that's important. So that doesn't concern me. I think that's what we've been on, is just an education mission for 5 years.
Yep. That's what you said that when we started this journey.
Yeah, no doubt. And so this is just this is from the MBA, and it's showing kind of projections for volume and where we're seeing. But I think what's important here is to notice what continues to go up is the yellow, and that's purchases. So, if the purchase market is the only piece of the business that's going to be rising, you need to be, how many people, if we did a poll of who's heard you need to be purchase oriented, I'm pretty sure I could safely say that's 100%. Everyone has heard that, right? So non-QM is a way for you to increase your purchase business because you have more alternatives to take care of every potential buyer and borrower that crosses your desk. And if you're not doing non-QM, that's going to be a lot more difficult. So again, purchase business is on the rise. We don't even really have to talk about refi business on the decline. Everyone's fully aware of that, right? That comes out every single day. So here's some interesting statistics, Andrew, that I don't know if you even know this, but these are things that we kind of have looked at when we started in this journey of building this non-QM business. But look at this. 50% of Americans have a credit score below 680. So
wow.
If you are only offering agency and FHA and jumbo loans, you're potentially, and we all know 680 is a pretty big cutoff, where when you get below 680, the number of loans drastically decreases. But so if you're only participating and you're only offering programs for borrowers above 680, you just wipe out half the population. If you get 2 calls, one of them is going to have a credit score below 680, and you don't have a way to help that borrower. Furthermore, look at this. A third of the country has credit scores below 620. And we know that's a huge cutoff. When you get below a 620, Fannie Mae is definitely out. FHA is likely out. There's really no options. But a third of Americans have a score below 620. Now, I don't believe everyone with a score below 620 deserves a loan. But we have seen that out of this very large population, there are plenty of borrowers that actually do deserve a loan, and they do have the ability to repay and the willingness to repay. They've just hit some bumps, and that's what's gotten them below this, this kind of that big cutoff of 620. So again, non-QM gives you the ability to just have something for these really large populations of borrowers. Make sense?
Makes 100% sense. Yeah, it really does.
Yeah.
It's amazing how many underserved markets are just being ignored, right now.
Yep, no doubt. So, and this statistic in the middle is pretty telling as well. There's over 15 million self-employed borrowers in the U.S. today, and I read something actually over the weekend. Andrew was talking about by the year, I think they said by the year 2025, they expect that number to more than double, that there's going to be over 30 million self-employed borrowers. So
that's awesome.
Most originators that are on this call have probably had that situation where the self-employed borrower told them they made a certain amount of income, they had the good credit, you're going down the line, and then all of a sudden, whoops, the 4506, the tax returns come in, and the number that they gave you was their gross number, right? Not the net number. and agency and government loans, that's the only way to qualify. You can only qualify with that net number. And we are kind of a big believer that the net number or the tax code really isn't the best predictor of a borrower's ability to repay, which is why we've created these bank statement loans so that we can actually look at alternative methods to determine a borrower's ability to repay, because we know the tax code allows you to write things off, but that doesn't mean you didn't have the ability to repay a mortgage. You just hired a good accountant. It's one advantage to being self-employed, right?
Yep. Listen, we invest in our businesses. We put money into our business. My dad always said this. The IRS doesn't penalize us for being a bad business person at the end of the year. So,
very, very well said. So anyway, it's a big population that's growing. You think about the gig economy. People are becoming Uber drivers all the time. It's that number is going to grow rapidly. So we, as mortgage professionals, have to have solutions for those borrowers, and non-QM is that solution. So anyway, foreclosures, a lot of people think of non-QM as, well, you had to have had a foreclosure, and we had a bunch. We had 18 million after the crisis, but we still have over 1 million per year even today. So that pool it's gone down, but it hasn't gone away. So there are borrowers that have had a foreclosure, could have been strategic or a short sale or deed in lieu or whatever their situation was. But now they're ready to buy a house, and they don't want to have to wait until the agency or jumbo guidelines allow. All right. So here's just kind of a visual. I'm kind of a visual person, so I really like, just what is non-QM made up of? And if we kind of just start from left to right, investors, foreign nationals, and we'll talk about some loan specifics. Bankruptcy, foreclosure, really that's the life event. So maybe somebody lost a job, and because of that, they lost their house, they had a health issue. Self-employed borrowers, already talked a lot about that. Low credit scores, kind of already touched on that. And then we have this product asset qualification that we'll speak about as well. But those are just kind of high level, the big categories. I would tell you these three in the middle are the biggest. The credit events, the self-employed borrowers, and then obviously the lower credit score borrowers.
So, Tom, before we go into this next slide, I wanted to do one more poll question.
Okay.
So, I want to get a gauge of everyone. Do you think non-QM loans are hard to close? Because I'm listening. I know I've heard that on the street a lot. We hear actually people saying that they're hard to close. We're dealing actually with different underwriting criteria, and people are unfamiliar with the process as they would an FHA loan or conforming loan. I'm wondering actually what we're seeing here, and it's almost like 50-50 off. 56% are saying that it's not harder to close. So we do have that. We're going to leave this open for another 5 seconds. So 5, 4, 3, 2, 1. Closing the poll, and there we go. I'll share the results up on the screen. So,
yep.
Tom, what do you think? Do you think this is in line?
Well, I think that is, to me, that shows the importance of partnering with the right non-QM lender, because they really aren't harder. It's just, I talked earlier about how, setting proper expectations. It's really just understanding the process. And that's why the fact that all we do is non-QM loans all day, every day, we've really, we work on perfecting the process every single day to make it easier to close loans. But our customers don't tell us they're harder. In fact, a lot of them come back and, we have a lot of testimonials, and They say, hey, this was the easiest loan I've ever closed. And, what
Wow.
deals, we provide tools to make these things easier. And I'm actually going to show you some of those in a little bit. But,
Yeah,
that doesn't. Yeah, go ahead.
I've had the pleasure of actually interviewing a lot of your brokers. So we have a little shameless plug for Mortgage News Network, Alternative Lending Top Originator Strategies. You can catch it every week on the Mortgage News Network. But so we've interviewed a lot of your brokers, a lot of your top brokers that are having a lot of success. And They went into it thinking it was going to be difficult, and they talk about actually how easy it really is actually to do these loans. And I guess it's just something to say about your system. And they all love the access to the underwriters. That's something actually you hear consistently with everyone.
Right. Well, it's not something that we just say. It's something that we do, and something that we live and breathe every day to do that. So yeah, makes sense. But again, so no, that poll question kind of makes sense. But I think that is still kind of a perception, not really necessarily based in reality. Now, hey, there are some loans. If you're in the mortgage business, there are just some loans that are tougher than other loans. But I don't think it's because it's non-QM or not a non-QM. I think they're just more challenging transactions occasionally. All right, so we back on the onto the presentation.
Yes, please. Yeah, And just I don't want anyone to think I'm rude, and actually, but I'm answering some questions here. So if you see me typing in the back here, it's not because I'm doing other work. But
okay, well, so now what I wanted to do now is actually just kind of show some examples of real live loans that we've closed, and really get people's minds thinking. Because at the end of the day, I want you to know about Angel Oak, I want you to know about non-QM, but I really want you to think more about the borrowers that are out there and how are you going to go get those. So I want to go through this quickly. I know we're getting a little shorter on time. So here's a situation where we had that self-employed borrower. I kind of already gave the example, right? They got a 758 credit score. So credit's not an issue. They told the LO make $200,000 a year. Tax returns came in. Nope. They make $50,000 a year on their tax returns. So they came to us with that scenario, and they found out again late in the process, and we introduced that LO to our bank statement product. We took the borrower. I believe this was a personal bank statement loan, although we can do business or personal. It was a personal, so we looked at the borrower's 12-month bank statements, looked at their deposits in their personal account, averaged them, divided by 12, and came up with the average, and that was the income that we used without using their tax returns to qualify them. So they got a $750,000 mortgage, which, based on rent and everything else, they were going to have no problem affording it. But if the LO had only had access to QM and agency loans, they would have never gotten this borrower in the house. So these are the borrowers that you're looking for, the self-employed borrowers that we know write off a lot on their taxes. Here's another one. We had, we talked about the credit issue. This was one where we found our loan officer found that was doing business with us late in the process. Borrower had really good score, 684 credit score, but they had an IRS tax lien that did not show on their credit report, right? So the tax lien showed up, the borrower went and they took care of it, but because of the time delay, they had to repull the credit, and their score dropped to a 614. And the loan officer told us a story. They're like, well, we just thought the thought was, assume the deal was dead. It was a max loan amount under the conforming loan limits, but they contacted us. We were able to get the borrower in that house, a little late, but still we got them in quickly once the loan officer learned about Angel Oak and learned about our non-QM loans. But again, 614 credit score, the options out there are minimal, if at all, and we were able to get the deal done and get it done quickly. So here's one. We had, so this was a borrower that was buying not a jumbo house, but needed a jumbo loan. It was a $1.3 million purchase, but it had a foreclosure 2 years ago. And if you're doing a jumbo loan and trying to do a prime jumbo loan, the borrower has to have pretty squeaky clean credit for the last 5, certainly 5 to 7 years, certainly 5 at minimum, but most of them are 7. But we have jumbo products that, really 1 day out of foreclosure, but 2 years or 4 years, it just, the product they land on depends on how far away that foreclosure is. But because of this, we were able to get this borrower in, get him closed, and it says right there, in 21 days from start to finish. So again, turn times, meeting those closing dates is really important. So here's another one. We had a borrower that sold their business for a lot of money, but then started a new business. But that new business had not been started for more than 2 years, and everybody knows in the mortgage qualification realm, you have to be self-employed for 2 years to get a loan. But we have this asset qualifier where we literally look at all of their assets, compare it to the loan amount and their monthly debts outside of their mortgage. And if they have enough to cover their loan amount and 5 years of debts outside of the mortgage, then they can qualify for a loan. And that's some pretty creative financing, but that borrower has the ability to repay because they can just strike a check and pay the mortgage off at any time. So starting to see a lot more of those loans lately. There's just a lot of borrowers sitting on a lot of cash, but they don't have the income or the job history that would allow them to qualify for any traditional loans. I mentioned earlier investors. Another scenario, we had an investor who had 19 investment loans, and we all know that Fannie Mae and any government loans have that a limitation on how many loans you can finance. We have this, what we call our investor cash flow, and basically the borrower qualifies based on the cash flow of the property. So we're not looking at the borrower's tax returns or their income or anything like that. We're looking at their credit, but then we're looking at the property itself. What kind of cash flow is this house going to generate? And is it enough to cover the mortgage that we're going to give? And we can actually be a little bit upside down on that. So maybe the expected rent is a little lower than the mortgage payment. That's okay. We can still work with those loans. But those are deals. If you only had agency as your alternative, you'd have no chance of getting those done. Or even if they didn't have 19, if a lot of those tax returns are so convoluted and so difficult, they're just challenging loans to get done. These investor cash flow loans are extremely simple. So like these. So here's kind of the big categories: self-employed, lower credit scores, recent credit events, the borrowers with significant assets, but you have maybe some other challenges regarding income, and then the investor loans, investor cash flows. Those are the big ones. You have any more poll questions out there, Andrew? What do you got going on?
So no more poll questions. I just got a bunch of questions. I'm trying to group them together, but if you want to take some now, we'll break them up a little bit. Take a couple of questions.
Yeah, that's fine. Whatever you want to do. If you see some good ones out there that you want us to cover, I would like, because I know a lot of the questions are around, how do I do business with Angel Oak, or am I approved? And so how about I just jump out of this and go to our website real quick? Does that make sense?
Yeah, you hit the nail on the head. Tom, about half the questions are, how do I get signed up? Is my company signed up? So yeah,
right.
We got a lot of
yeah,
those.
let's do that.
I want to make this point. This is said by Kevin Mitchell. He says, anytime you don't have to deal with a bank is a good day in the mortgage business.
I love it. All right, that's good. All right, so here's our website, and a couple takeaways from this. Hopefully, a lot of takeaways, but one is if you just remember our website address, angeloakms.com. It's like Angel Oak and Mortgage Solutions. That's what the MS is. angeloakms.com, and that's where you can really find out a ton of useful information. And I'll just kind of show you what the website looks like. And really kind of, let's just play around here. Contact Angel Oak. I mentioned earlier that we have coverage across the country, but here it's find an AE. And if you click on that, up pops the map of the whole country. And everywhere in green is where we have coverage. So let's say you're on this call and you're in Texas. You would just put the mouse over the Texas, click on it, and it's going to pull up all of our account executives. You can see how much coverage we have just in Texas. And then you can reach out to them. We've got phone numbers to contact information, and you can do that in whatever state you live in. So start there. And in fact, the people that were asking if you were approved, start there. Find an account executive. They can tell you, and then if you're not approved, they can help you through that process as well. That's really simple. Our broker package, I'll show you that. That's right here in the middle of our website. So you click the broker package and just download it. The other main resource, and I'll tell you that people talk about that we have that they love, is right here, Andrew. It's called Quick Quote, and it is exactly what it sounds like. It's a quick quote. So you've got a scenario, maybe an agent called you with it, or you pulled credit on a borrower and you're talking to that borrower. You can go to our quick quote, and all you do is you just put in your mortgage company. I'll just make up a name here, 123 Mortgage. And the reason we do that is that we offer lender paid compensation. So if you're approved with us and you've signed up for lender paid, the quick quote will be modified based on that. But so you look at this, and we ask a handful of questions, Andrew. It's so simple, it takes seconds. But you put in the credit score, the loan amount. Let's just say it's over the conforming limit. I want a 75 LTV, and I've had 0 lates in the last 12 months. As soon as you answer that the fourth question, it starts giving you options. And then you can go down and you can change some criteria. Let's say it's a cash out. It'll start making changes for you. Income documentation, let's switch to 12 months personal bank statements. That was business. But right as you're making those changes, all the information down here is changing. So the interesting thing as well, in this scenario, Andrew, I asked for a 75, but it gave me the 75, but also said, hey, if you want to do a 90 on this bank statement loan, you can do that. And so change the income type to full doc. The rates are modified as well. So, you start looking at this. How long did that take? Just 15 seconds, 20 seconds?
Yep.
And so you can go in there and just get an answer. Now, I wouldn't advise that you start quoting rates to borrowers or anything like that, but you just kind of get an idea of where this product would fall or where this borrower could potentially land from a loan perspective. So
Tom, let me ask you a question, because you talked
Sure.
about lender paid. So we have someone actually asked, can you get lender paid and borrower paid?
So yes, right here, in fact, we give borrower paid rates and lender paid rates. Remember, the fictitious company I put in there is obviously not approved with us, so there is no lender paid rate. So if they didn't sign up with us under lender paid, they would have to be borrower paid, but we can do either or on each transaction.
Fantastic.
Good question.
Great. All right. So I don't. If you want to continue with this, and I'll you let me know when you're ready. I'll start slamming you with questions. We got a bunch.
I want to leave. Yeah. So I was just going to show from here. Once you see a little scenario right here, all you do is click pre-qualification request, and when you do that, that takes you to the next page, which is where you send this information to your account executive. And when you do that, and all of our account executives are right here, you pick your account executive, and when you do that, fill out a little information, upload 1008, 1003 credit report. If it's a bank statement loan, you actually upload those. You hit submit, and that goes directly to that account executive, and we're going to get you an answer back within 24 hours. So that's when you can start quoting rates to your borrower, is once we've looked at it and said, yep, that's a fit, we can do that loan at 75% LTV, and here's the terms of the loan for that borrower. So real simple, doesn't take a lot of time. I want to go back to the homepage to show you a couple other resources that are very useful. We might not have a lot of time to talk about this, but one of the things that we found to be the most important part about non-QM and actually originating a significant amount of non-QM is that you market non-QM. And so if you're an approved broker or correspondent of Angel Oak, we provide you with marketing materials. So it's really important that you're not waiting for an agency fallout, a loan to blow up, and then, well, let me see if there's a non-QM option. You actually need to take these products and programs and the marketing support that we provide and take that out there to your referral sources. That's really important. So I'll show you right here. Once you're approved with us, you would click this big green box that says log in. Excuse me, Andrew. Then you would go, you'd fill out your email address, password, log in, and that's our portal. That's where you're going to find all the loans that you have in your pipeline with us. And right here, we have this marketing portal. So the marketing portal is really important, and our top producing loan officers know this portal very well. Let's see if maybe I didn't click it right. All right, so right here you can click flyers, but if you look, we've got 10 lots of flyers. We have Spanish flyers that are there in Spanish. So all you do is you click on one. Let's say this one says bank statement program. You click on it. And one thing I want you to note, Andrew, is there's nothing about Angel Oak on it. This is for you as an originator to market the product. So you would just put your logo right there. You put your information, your name, contact information right here. Then you can save it, print it. You can email it, print it out, take it to you when you go to someone's office. It's yours. And we have as you could see before, there's all the different programs that we offer. You can print out these custom-made flyers that are basically coming from you. But again, it's a really critical piece of the entire non-QM effort is that you take this and you market to your realtors and other referral sources, because frankly, they don't know that these products are available. And once they know that these are available, they get very excited because they know these borrowers, and they've been turning these potential buyers away for years. So it's good stuff and something that I highly recommend.
I mean, and also, can't forget, actually, so many of these real estate agents are like the perfect candidates for these loans themselves.
Yeah, they get it. You're right. Yeah, that's a great point, Andrew. They absolutely understand on a bank statement loan why that would be a good loan, and so it just opens up the pool for everybody. We talked earlier, if you want to do purchases, you need to have more tools. Well, yeah. Excuse me, in order to get more purchases, the realtors need more tools. And so this opens up lots of opportunities for realtors to go find new potential buyers that they thought had no chance. And maybe they learned a few years ago that type of borrower wouldn't work. So they're filtering those borrowers out. And you may not even know about them. These realtors have gotten real good at understanding guidelines from agency and government loans. So they're doing a lot of pre-qualifying before they want to spend time showing houses. So you get out there and show them that there's some new products and new programs, and if they work with you, you can offer those. They're going to get very excited about it.
Yeah, because they're not doing a lot of pre-qualifying. They're doing a lot of pre-denying is what they're doing right now. So I think, that's
yep,
that's great.
You got it. So again, it's our website, angeloakms.com. Lots of resources. Andrew, you want to maybe touch on a couple questions here? We
got a bunch. We're not going to get to everyone, so we apologize, but everyone will have their questions answered. So just don't worry if we don't get to it. Don't start, flaming me here. All right, so let's start off. Got a lot of people asking about your foreign national program. Can you talk a little bit about foreign nationals?
Yeah, sure. Foreign nationals, I think the most important thing is to define what that means. That means somebody that lives and works in another country. So it's not the person who's coming into the United States and working here. That's not a foreign national. So if they live and work in another country, then we have a foreign national product that goes up to a 75% LTV. It's a great loan. So and they're pretty easy to originate as well.
Fantastic. Okay. Next question. Hold on for a sec. Let's go to. No, not in New York. Well, when would you choose? Yeah. When would you choose non-QM over QM?
Well, I guess a lot of it is in most cases. QM loans, if a borrower can fit into a QM loan, that's probably the direction you're going to want to take them. However, our rates really haven't been moving through this environment. And so we're now seeing And another really important piece to note about non-QM is any loans over 80% do not carry mortgage insurance. So, earlier when I was talking about the lower credit scores, if you try to do a lower credit score below 680, and then you need or want to do an 85 or 90% loan, the MI factors get extremely expensive. So 85, 90 with no MI starts to make a lot of sense for a borrower. And so we're seeing, some of the really good LOs doing education of the borrowers that, hey, listen, I know you wanted to put 20, 25% down. And if you put only 10% down on a conventional QM loan, you'd have to pay a lot in mortgage insurance. But let me look at this non-QM 90% one loan without MI, and you save some of your money, maybe pay off some other debts, and that's going to put you in a better situation, even though your loan amount's a little higher. But you have more capital to do other things with your own cash. So that's it. And then, simply, if somebody, self-employed borrower, if they cannot qualify with a tax return, that's a non-QM loan. DTIs, we allow up to a 50% DTI all day long. And we all know the QM cutoff is 43. So that's another area that it makes sense to go down the non-QM road.
So next question, we've got a couple of people asking about this. Are there any drawbacks or increased risk to brokers originating?
You cut out just slightly there, maybe on my end, but is there any risk to the broker? Absolutely not. We make all the credit decisions. And if you remember, out of the 11,000 loans that have closed, only 8 have foreclosed. So we're taking all that risk. We underwrite it, we approve it, we close it. So risk to the broker, really the only risk to the broker is if you commit fraud, but that's kind of standard in the mortgage business. But as far as loan risk, performance risk, there is none of that.
Okay. Can you do this for cash out refi, in LTV cash out amount?
Yes, absolutely. And in fact, you can go to that quick quote, remember, and you could change it to a cash out instead of a purchase or a rate and term refi. And the quick quote will guide you directly what's the maximum loan to value for that scenario. But yes, the LTVs on cash out are extremely aggressive.
So you got a bunch of people asking how low you can go with scores.
So our minimum credit score is 500. I will tell you, we don't do a ton of those because, if somebody has a 505 credit score, they probably don't have 20% down. However, what we're starting to see now is some of those lower credit scores doing cash outs, so they can tap into their equity and then improve their credit situation. So we'll go all the way down to a 500. We look at their mortgage history, and if it makes sense for us to give them that cash out, then we're going to do it.
You require a second sign? If yes, what are the turn times?
Andrew, could you say that again? I'm sorry, I lost you there in the middle.
So no problem. Do you require QC or a second sign on all? If yes, what are those turn times?
Oh, absolutely not. No, we are we are the lender. So we're making all the decisions. That's kind of an astute question because that securitization piece does require all loans to go through a second review, but we do all that after closing, and it has no impact on the turn times to get the loans closed. So again, we're the biggest lender out there. This is all that we do. That is not part of the lending process before closing.
Great. Do you allow to be assigned by another lender?
Shoot, Andrew, one more time, please.
So do you allow an appraisal to be assigned?
Oh, okay. Like a transferred appraisal. Yes.
Exactly. Yeah.
The one requirement that we do have is the appraisal does have to come from a licensed appraisal management company, a licensed AMC, and yes, we can take transferred appraisals.
Okay, fantastic. I'm just going to switch the audio on this,
If
so
I
if I
lose you
lose
for
you
a
for a
second.
second.
Okay.
Hello?
Yeah. Yeah, I can hear
Okay,
you.
hopefully you hear me okay. Hopefully I sound a little better. Are the fees higher?
I don't believe they are. I don't know all fees in the industry are we have one fee of $14.97, and that covers everything that we do. So there's not a lot of little fees. It's just the one.
Got it, got it. Okay, there's a lot of people asking about fees here. All right. Overdrafts allowed?
Overdrafts allowed. I'm assuming that's for the bank statement loan, and the answer is yes. There are some requirements though, and there, if they have overdrafts every single month that we look at, and it's a large number, that's going to cause a problem. Not sure that person that is upside down on their bank account every single month, adding a mortgage to their debt, it, really makes sense. So,
Yeah.
but they are allowed to a certain degree.
Okay. What kind of LTV with investor program and good credits, and what are the reserve requirements?
So our investor loans go up to an 80%. Reserve requirements are, I believe it's 6 months. I'm pretty sure it's 6 months on the investor cash flow. Hey, I do want to ask one, or not the question before about the NSFs on a bank statement loan. That's one thing that we really do that makes the process so much easier. Is we address. Do you remember when I showed you that pre-qual page? There's a way to upload every single bank statement. Your AEs are going to look at the bank statements, and we're going to give you what income we'll use for that loan up front at the very beginning of the process. So if that borrower did have some NSFs, we're going to tell you within 24 hours, really early in the process, that we're going to be okay with it or not. And this is the income that we're going to use. So, before you go to, all the way down the line to find out, no, we can't use that. That's really where our expertise in the field comes into play, Andrew.
Fantastic. Can you do LLC for investor loans?
Yes, absolutely.
Fantastic. Do you service your loans?
Yes, we do.
Okay. What is your max loan on a purchase?
So our maximum loan per guidelines is $3 million. We'll go up to 85% loan to value, $3 million loan, and we will, in the right scenarios, make exceptions and go higher than that when the loan makes sense.
Fantastic. So listen, I do want to commit, stick to our commitment, saying that we keep this, an hour. We are like 1 minute over, so I apologize to everyone for taking it a little longer. But Tom, as always, thank you so much. So next actions that you would suggest for anyone that's on this call?
Go to our website and find your local account executive, and shoot them an email or give them a call, and they'll reach out to you immediately. That's the next step.
Fantastic. All right, and everyone, thank you again for joining us for another NMP webinar. Really appreciate the support. We've got a great lineup of webinars coming up actually in the next couple of months, and 2019 is going to be unbelievable. We're going to be doing a lot more with Angel Oak, getting people actually, a little more educated about the product and how to sell it. Be on the lookout if your question wasn't answered, which I'm looking at a big list of questions that weren't answered. You will be, someone will get in touch with you to answer any of your questions. So thanks
Awesome.
again, Tom.
Thank you, Andrew. Have a great day, everybody. Thank you.